Are you ignoring the warning signs flashing in the stock market right now? Because today, we're diving into why red flags are popping up everywhere and what you can do to protect your investments. Stick around and you'll learn how to spot trouble before it hits your portfolio. Let's get right to it. Investors are starting to get nervous, and for good reason. Volatility is creeping back in, economic data is sending mixed signals, and even the pros are dialing up their caution. But what's actually going on beneath the surface? First, let's talk about the numbers. The S&P 500 has been on a wild ride this year, hitting new highs but also showing some sharp drops. And here's where it gets interesting. Trading volumes are thinning out, which means even small pieces of bad news can cause big swings. When fewer people are buying and selling, it takes less to move prices. That's a red flag in itself. But that's not all. Look at corporate earnings. While some companies are reporting strong profits, others are warning about slower growth ahead. And when you see big names, think tech giants or major retailers, start to sound cautious. It's a sign they're bracing for uncertainty too. Now, here's what no one tells you about risk. It doesn't always show up when things are obviously bad. Sometimes the market looks fine on the surface, but if you dig a little deeper, cracks start to show. One example? The so-called fear gauge, the VIX index, is inching higher. That means traders are quietly hedging against surprises. And there's more. Interest rates are still high, which makes borrowing more expensive for companies and consumers. That puts pressure on corporate profits and can slow down the economy. At the same time, inflation isn't falling as quickly as some hoped, so we're stuck in this weird middle ground. Not enough growth to feel confident, not enough bad news to call it a crisis. But what does this all mean for you? Well, now is the perfect time to check your risk level. If you haven't looked at your portfolio recently, take a hard look at how much you've got in stocks, bonds, and cash. Are you prepared if the market takes a dip? Do you have enough diversity to weather a storm? Even experts say it's smart to rebalance before things get rough, not after. And here's a stat that might surprise you. Historically, markets drop about 10% once every year or two. It's normal, but if you're overexposed, those drops can feel a whole lot worse. That's why risk management isn't just for the pros. It's for anyone who wants to build wealth and sleep at night. So, what should everyday investors do? Keep your emotions in check. Don't let fear or FOMO drive your decisions. Instead, focus on your long-term goals, stay diversified, and consider setting aside some cash for opportunities and for peace of mind. And here's the bottom line. Red flags don't mean you should panic. They mean you should pay attention. The smartest investors are the ones who prepare, not the ones who react. If you found this breakdown helpful, hit like, drop a comment with your take, and don't forget to subscribe for more straight talk on the markets. Because in today's market, staying informed is your best defense and your biggest advantage.